And I think that is everybody on now. So we will we'll get started. So thank you for everybody coming through. We've got, see here, quite a number of different countries on. So that's great. So look, we're going to start out. First of all, introductions. We have Reese Boyle on with us. So thank you very much for making the time out for us, Reese.
Mark, no worries.
Good stuff. And Reese is from API Global, who are partners in sourcing some of the best developments throughout the UK. So I'm sure we'll get a bit of chance for Reese to input during the course of this webinar. And also at the end, when we go through the questions, both Reese and myself will try and answer as many questions as we can with regards to either specific African investments into the UK, whether it's the economic situation and sort of specific questions to you. So we can go through them and answer them for the rest of the group as well. So to start off with, obviously these are the points that we're looking to cover throughout the rest of this webinar. Naturally going a little bit about the economic situation at the moment, along with the forecasts. What are the indicators that we look for? Talking a little bit about other countries as well as Africa, as well as the continent of Africa. So other continents, Europe, Asia, the rest of it, who are investing and why. And then going into specifics with regards to both the wider continent of Africa and then specific countries within Africa that we can discuss how Forex is affecting that. And then we can get onto the question and answers. So to start off with, the UK economic situation as it stands, it could be argued that the UK was relatively late in terms of a health response to the global pandemic that we've all seen. So it's been an incredibly strange time, but in investments, but also obviously wider in terms of within the community with regards to the pandemic that swept out of Asia and now has really gripped Europe quite significantly. And although, various political parties and the media may suggest that, potentially the UK responded quite slowly to the health impacts of that, what the UK did, and from an investment perspective, is that the UK was incredibly fast at responding to the economic impacts and really were one of the first global countries to have a real strong economic response. Historically, as we all know, Britain famous for its banking and having control of, I think around 40% of the global banking economy. If we include the territories that Britain has significant influence over. Britain obviously prioritizes the GDP and the financial aspect of the country. And this is where sometimes, in these sets of circumstances, it can help to have these responses. Boris Johnson, as you may remember, or if you don't know, Boris Johnson, the Prime Minister, prior to himself contracting COVID-19, implemented what's called a furlough scheme, in which employees would have 80% of their salary covered by the government should their company have to close for the term of the lockdown that's now in the UK. The lockdown in the UK is not quite as strict as many other countries throughout the world, but equally, most companies cannot go in. Some building sites can still run to a certain extent, but the vast majority of employees can't go in. Equally, on top of that, another stimulus that was put in is all property owners were given 3-month mortgage holidays. And then on top of that, with they reduced the base rate to almost a record low, a base rate. So mortgage costs have come down significantly for everybody, meaning that it gave a certain amount of increased confidence of the British people during what is a global uncertainty. Some of you might have seen, or some of you might follow, Money Saving Expert, which is a sort of a guide to helping. It's an independent company that they're almost to help people in terms of their personal finances in the UK. They have a huge following in the UK, and they did a poll where the question was posed whether the individual thought they would be poorer, richer, or the same following the COVID-19 lockdown. With tens of thousands of people responding to that, there was a fairly even split between people who thought they'd be poorer, people who thought they'd be richer, and the third, obviously, people that just didn't see much change at all. And it gives us a little bit of confidence of where the people, so the local investors and the local renters are in terms of their own mindset. Obviously, the economic impact of the UK does have risk, does hold risk. Even with the furlough scheme in place, there is, the possibility that some companies may hold back redundancies until after the furlough scheme is finished. Now, and unemployment is expected to rise from the record low that we had at the start of the year at 3.9% to maybe 6 or 7%, depending on sort of which forecast that you look at. This would put the UK to around 2014 or 2018 levels of unemployment. So it's not massive unemployment problems, but again, there's marginal increases which we'll cover off in a little while. Now, there's obviously a good possibility that could be lower than that as well. But it's important to understand how the furlough scheme works, because I have had questions from my investors, and Reece, I'm sure you've had the same, whereby clients are saying, right, well, surely the unemployment rate will increase dramatically after that if the government are paying 80% of everybody's salary. But it's important to understand that companies first have to pay their staff their salaries, and then afterwards are allowed to go back and claim 80% of the salary back from the government. So again, what we're suggesting, or what that shows, is that companies who had to, or who don't have the money, have already laid off the majority of the staff. The remainder have the cash flow to be able to pay these staff, and so any unemployment coming after that should not be as significant as that we've already seen. Because of that, what most economic forecasts are showing is a short-term drop, because as with every country in the world, there's closures and isolation and the rest of it. Companies cannot run as normal, and so a short sharp drop followed by a bounce back, and these are and these bounce backs are expected to be higher than the drop itself. So that's the likes of Oxford Economics, Savills, Knight Frank. It's not just obviously our companies that have looked into this. These are also external resources that you can look at. Other external resources have said they'd expect it to be higher, such as CERB, not to be confused with CRBE. They're expecting a higher drop, which has been picked up by the press, but it is not really agreed with by most economists or by any other economists in that fact. And it's, there's a potential that was a PR exercise by them, but another one that you can look into and compare that with the other reports out there. Again, when we're reading the media, and I think it's an important point, it's a factor that we covered off in our previous webinars, is to be sensitive about the type of information you take out of the media. Again, a lot of you will remember the fear mongering around Brexit, whereby there was conversations of 30% drops in property prices, and 20% drop in the pound sterling, and the rest of it. For most investors, or for most sort of experienced investors, it's quite clear that would never happen. But again, because you are not based in the UK, it can sometimes bring a little bit of fear about if that's the sort of reports you're reading. So again, it's important to go back to the actual facts, what underpins the UK property market, and ultimately the correct sources of information, I think, is really important. Now, what key points underpin the property market are average salaries and affordability, the supply and demand of property, the access to lending, and the rates that people can lend at. And then obviously in and around that, there's a little bit of market sentiment. So individuals, will be scared by the media, but the media tends to change after investors have already invested. So for us as a group of investors, we're wise to look at actually the metrics that underpin the performance of a property investment. And I think it's worthwhile just crossing over that very, very briefly, in that average salaries and affordability is a huge impact. It's one that we look at quite well. We look at it all the time, month to month, in every single postcode of the UK, and understand where the average, both average salary and average household income is. Now, that's the one where I think that people are suggesting there could be some sort of drop in property prices if people can't afford property. But again, I think when we're looking at the levels of unemployment that we are, if we're looking at a 2-3% growth, we shouldn't see a significant drop in average salary. And realistically, I think that, again, looking at the reports that have come out, the average drops in employment, so the growth in unemployment, again, is expected to bounce back after a quarter. So again, it's not expected to be continual. So, and when we're looking to invest in property, we're looking at a longer term. So really, we should be looking at, well, should we invest now or in a few months, or should we, if we're investing now, we're really looking at 3, 5, 7, 10-year time for us to be able to get the profit out of that. And again, we're going to come back to that specific to your country that you live in. The next one, obviously, supply and demand. We know that there's a huge undersupply in the UK. Again, the population density within major cities is huge, which is predominantly why the UK performed slightly worse than other European countries in terms of the susceptibility to this COVID. Was very much down to the fact that there's people live in city centres. There's a huge amount of population density in the likes of every main city within the UK. And again, we've been supposed to be year on year, the UK is supposed to be delivering 300,000 properties. And I think, Reece, we're about 220,000? Is that sort of the top end that we've been hitting in terms of the UK?
Yeah, just in terms of percentages, the last 5 years, it's been on average about 35, pushing 40% deficit in terms of the demand. So yeah, about those figures.
Okay, yeah. So again, like with anything, supply and demand is a significant of importance, and is one that will push property prices up. Again, access to lending and the rates of lending, naturally, that's a 2-point thing at the moment. At the moment, some lenders have come out of the market, so some lenders aren't in. More often, the ones that have come out are actually specialist lenders who don't borrow from the Bank of England. So that's for people with maybe, there's some clients that have very, very bad credit rating. Those people are struggling to lend at the moment. So that's a minor problem that we have. But overall, in terms for our clients, is that people at the moment are able to lock in all-time low sort of base rates, and people are able to lend their actual mortgage rate is actually lower than what the base rate has been historically. So again, we've got some of the best sort of lending rates we can possibly get at the moment. And if people can lock them in for 2 and 5 years, again, what we're seeing is some people are taking advantage of that. So ultimately, really, it then goes on to who's investing in UK property at the moment, who's not investing, and then why. I think, and then that should give a little bit of an understanding of where you sit within the market and where your particular country sits. I think overall, you can help me with this one, Reece. But overall, for the majority of European investors, they're split into 2 halves. So Europe, and if we're looking at Europe, Asia, Africa, and the Americas, I'm noticing that Europe are in 2 minds. So some people are taking advantage of being able to negotiate decent property prices. They are naturally still taking advantage of under market value properties that we have, but then still being able to lock those in at really very low interest rates. So if they're comfortable with their own cash position, they're able to buy now, get some good deals in the market, less competition at the moment because there's less transactions going on, and then be able to fix that in on a 2-5 year mortgage, confident that the market's going to pick up as the sort of economic advice is suggesting. And then what I'm seeing is the other proportion of European investors, as because their money is in pound, they don't get the benefit of the forex exchange. The other ones are saying, look, we'll hold out for 3 or 6 months, or alternatively, I want to look at properties that are going to be completed in 6 or 12 months time when the market's going to be pulled back. So naturally that's a fairly straightforward set of circumstances. I think that market is easier because if you're earning in the pound, you can't take advantage of the forex. You look at other factors. That's almost converse to what we're seeing at the moment with the likes of the US at the moment, Hong Kong, Singapore, China, and Japan, who are seeing who have this almost a sense of urgency. They have a short-term window of opportunity at the moment whereby the pound is very low against their own currencies, which are performing quite well as they're starting to come out the back of the pandemic, and there's a lot more industry going on. And what I'm seeing is a lot of these sort of key Asian markets are taking advantage while they have that strength. Again, with the US, we're coming to, it looks like the US dollar will drop, and those tied to the US dollar. So again, Middle Eastern clients are buying at the moment, trying to get their money across in this short window before obviously the US dollar drops or before the pound increases against their currency. So they again have a slightly different set of circumstances in those parts of Asia. And they're trying to take advantage of that as much as they possibly can at the moment. So they're looking for stuff as close to completion as possible, or at least trying to move their money across the people who are investing. Are you seeing sort of similar response there, Reese?
Yeah, so for anyone who doesn't know, I actually reside in Dubai, purely from a time zone perspective. But yeah, a lot of Middle Eastern clients who are earning dirhams, dollars, Saudi riyals, which is pegged to the dollar, have obviously seen that as an opportunity. The pound has strengthened slightly over the past couple of weeks, but on a 3-year average, you're still looking at about a 5% discount on sterling. So that has definitely increased in transaction levels. And I think even going back to looking now where what I'm trying to suggest to a lot of clients is that if you look at, okay, Brexit, we had the same pessimistic outlook from a handful of investors. Some of the regions that we focused on in your northern cities of Manchester, Liverpool, Birmingham, saw strong growth from 2016 to 2018. Then further back into 2008, the global financial crisis. I think if you were lucky enough to invest into London around that period, that's where we saw some of the strongest gains in times of uncertainty. So having that window of opportunity on currency with, as you mentioned, an undersupplied residential property market in the UK, clients are seeing this for the longer term of what the UK property market offers. So yeah, like you mentioned with Asia, they are still looking at about between 12 to 14% of a discount on sterling. So that's a major factor. But every city, every continent, every different region has its own offerings, and we'll go into currency, I think, on the next couple of slides. But it's really about taking each client and offering credible advice on whether it is viable to actually invest or whether you should sit and hold. So I think, yeah, we'll more than likely cover this off on the next couple of slides.
Now that brings us into sort of the Africa position as a wider economic impact within Africa, and importantly then into specific countries, because the diversity of Africa is much more significant than Europe, both social and economic factors. And we can look at some of the major impacts and what is going on within Africa so that we can start to understand when is the best time to invest, whether it's now, whether it's never, whether it's in a few months' time, in a year's time, etc. And the best questions that I'm getting from my investors in terms of the position, so my investors have either money sat in certain countries in Africa at the moment, or they're based in Africa, earning in Africa, and want to know when is the best time, or how, will there be a best time, is to take a step back and first and foremost is understand, one, the economic impacts of COVID-19 have hit every single country, bar none, economically in the world. So really the question is not, is buying in USA or is buying in the UK is now the best time in terms of that specific country? Because as we discussed before, people within the UK or within Europe don't have currency fluctuations. So they don't have to decide whether their country is performing better or going to perform better than the UK. They are based there. Their money's there. For my other clients, as we discussed before, are based in Asia, or in earning in dollars, they have dollars. They're seeing now is a very good time because there's an expectation that the dollar will weaken significantly in a few months' time, and an expectation that the GBP will bounce back from almost every economic forecast bar one that I've seen. So it's first of all understanding that the smart question is not, is there an economic impact? Because of course there always is. Every single country will have an economic impact. The question is, if you've got your money in any country in Africa, is will your country or will the country that you have that currency in perform better or worse than, for our example, the UK? And will it perform, and what time frame will it perform better or worse? As in, when we come out of the pandemic, which we all will, we're going to come out of it. Economies will sort of push back and bounce back at some point in most countries, or most countries that you're looking to invest in anyway. And then the question is, well, will your country that you're based in, will it bounce back? And if it will it bounce back in the next sort of 6-12 months or 3-6 months like the UK will, or will it take longer? And therefore we get to understand, is now a good time, is the best time in 3 months, 6 months, 12 months, etc. And primarily your advantage at the moment, or the play that you have, the advantage that you have, is understanding when you should invest and whether you can invest quicker than other investors and get a better deal. So some people are obviously, there's some deals in the market at the moment, and so whether you can take advantage of it now, whether you're comfortable to do that, is a completely different question. But all we can look at is the numbers behind it all. Now, as we mentioned, the diversity of Africa is significant, but the World Bank put it quite well in terms of the effects of COVID-19 on the continent in 3 main points. They are trade disruption and falling commodity exports, reduction in the amount of investment and other money coming in from abroad, and then the day-to-day economic problems caused by lockdowns and other restrictions, as we've seen around the world. Now, commodities, obviously significant factor for my clients within African markets. Even the major markets are being significantly affected. So one of the major parts is clearly oil and other commodities has hit the continent with a double bubble. We've had this huge reduction in the value of many commodities, and as we've all seen, oil, although it's rallied slightly, it's significantly, the price of oil is so low that it makes it very difficult for major oil exporters, Angola, for instance, to actually come out of any recession, and then even places like Nigeria, whether the value will get to a certain amount that it will allow Nigeria to put in place the economic stimulus to be able to pull themselves out of the effects of the pandemic. And if they can pull themselves out at a fast enough speed to keep up with the likes of the markets that you're looking to invest in, or keep up with the UK for the purpose of this webinar. So that's a major question. Even when we look at things like copper, I know a couple of my clients are major investors in copper. It's gone from just under $3 a pound. Now it's hovering around the $2.20 a pound. This goes for huge amounts of commodities. Now, at the same time, the currency is weakening. So what we're finding is with major economies within Africa, within the 46 countries of Africa, one of the major impacts is even if somehow Africa as a continent is able to avoid the human toll of COVID-19, it looks almost impossible to avoid significant economic impact. With currency on one hand weakening, and then the commodities that we're able to sell from Africa and the major countries in Africa reducing, we have two weak hands at play in terms of the exchange rate and the commodities market, which ultimately looks like it will really affect those countries. If you add into that the fact that there's a significant amount of investment reduced in Africa as well, so international investments reduced catastrophically at the moment as international investors are dealing with short-term problems at home, that adds on to an extra problem for the overall continent over and above the at-home day-to-day economic problems caused, which are in every single other country. Now, obviously, major countries, so if we look at the biggest markets within Africa, we look at Nigeria and South Africa, with these commodity prices falling significantly, and you can probably take wine out of that for South Africa, but with these falling significantly and the countries coming out of a recession and really having since the recession, not particularly inspiring return from that or inspiring growth since the recession, it's going to make things even more difficult. And the likes of these major markets are a major concern to the World Bank and the IMF, and also normal economic forecasters. Now, there is stimulus. So although, much like, if we compare it to the UK, South Africa has put in stimulus of 66 million to help small-scale farmers to support food production. Other African governments like Nigeria have pledged financial support to the most vulnerable people. But there's not a huge amount of evidence that this has had a significant impact on the short-term economy in the same way that, for instance, we discussed with the UK. Now, on top of that, there's been stimulus such as reducing the cost of borrowing, so mortgages and loans. But if we look at the overall picture, although this may support you as investors, the overall picture within the economies, when people have less mortgages and people have less loans, it affects a country much less. The stimulus isn't quite as strong within the country. So although that it comes across as, okay, well, we don't want to make it sound too scary. What it does is it offers opportunity for you as investors. So ultimately our job isn't to tell you what's wrong with your own country and your own currencies, but it's really to understand whether that presents an opportunity within the UK. And really the point of this whole thing is to just raise that question for you. Your question to yourself is, and we'll go on to the actual historical currencies in a minute, but your question to yourself is, will your country come out better or worse than the UK over the next 3 to 6 months? And then when will your country become strong? And will it improve over maybe the next 2, 3, 5, 10 years? And that's when you'll start to be able to put in your own mind, when is a good time to invest in the UK? Clearly you have a desire to, otherwise you wouldn't be on the webinar, or clearly you have an interest in it being an opportunity. And so what we have to help with is just raise that question, and in between us we can discuss that. Again, what's very, very, very important is that regardless of your own or any geopolitical or geo-economical factors, your specific set of circumstances are different to your neighbours and to everybody else's. And so what I'd like to be able to do is, obviously we've got the question and answers, but if any of this does raise questions for you, it'd be very worthwhile for us to sit down and look at your specific set of circumstances. Forget about property altogether or specific properties, but look at, okay, I have X amount of money. and my currency is depreciating at X or Y, or I believe it's going to be here in the next few months with the support of our Forex guys who do our numbers for us in the currency exchange. And then from there, what we can do is sit down and look at when in the next 3 years, for instance, where on that timeline would it make sense for you to invest? And then in and around that, how much to invest. And then after that, much further down the line, we can start to talk about, well, what type of property does that look like? What type of area of the UK does that look like? Or does it say UK is not a great investment for you, which is often the case in our conversations, in which we'll help you with either other investments through our partners, or we'll point you to a different place altogether. So again, or just say, hold it in your bank for the time being. So these are the questions that should be raised from this sort of webinar. Now, where does it put investors? So what I wanted to do, show some examples, because the most important thing with economic factors, when we look at either currency or really everything to do with the property market as well, when you look at super forecasting or people like ourselves who've historically been very good at forecasting both rental values and property values in the future, your starting point is always the last 10 years or as wide a picture as you can look at. So here's an example of the Rand. So for you guys that have money in South Africa or live in South Africa. So the first thing we do is, what's the wider picture? So the line you can see here that we put on is 10 years, right? So this is 10 years. And what it's showing us is the pound strengthening against the Rand. In real terms, what it actually shows is the Rand weakening against the pound, because the pound, has been fluctuating against the dollar, etc. But what it's really showing us is that over 10 years, the Rand has weakened. Now, the reason it's useful to look at this long-term view is, within that, there's going to be fluctuations around. You've got day traders who are trading currencies, as we all know. I'm sure a lot of you do that as well. So you trade currencies day to day. That creates a lot of fluctuations. But what we can do is look at the overall trend line. And then once we've got a position of the overall trend for 10 years or 15 years, wherever you want to look at it, then what you can do is, from that trend line, make an assumption that over the next 3 months, or even better, over the next year, which is a lot easier to forecast, 3 years, 5 years, are we expecting your currency to improve or depreciate against the pound above? So will it be above or below that line? Again, I have clients, more recently, clients in South Africa asking, Mark, we've had real problems with the Rand against the pound. Should I wait a few months and then invest? Will it come back down to the levels it was before, as we can see here, around that 17, 18, away from this up towards 24? Again, that's a question for our Forex guys. So all of these numbers and the future predictions that I'll show you were created. These are some of the best Forex guys in the world. That's where their predictions come from. And I'm not a day-to-day trader. All of my investments, whether it's property, my personal investments, whether it's property, or equally in other markets, I look at long-term investment anyway. I feel like I'm much more comfortable with that, because I know I've got a lot more control over it. So again, this is a great example. Reality of it is, what it shows us is that my investors who have been investing with me for many years around here have done incredibly well. If you bought 10 years ago, you've doubled your investment, all right, in 10 years. Plus, not only have you doubled your investment on the currency exchange, you've then had all the property price growth in that time, which again, with a decent investment with us, we should always be investing above the market growth. That's our job. You might have doubled your property value as well. So for my Rand investors who bought in this time here, March, 2010, you might have quadrupled your investment level. Incredible investment, and congratulations. So again, what we need to do is we'll look at this. Is it around the trend line? It is, roughly, but again, you can put this trend line down here, and then decide, all right, I'll wait for the currency to come down. What it does for us is it gives us an idea of, where is the economy going to go from this point? Is the Rand going to strengthen? Is it going to come out of COVID-19 better, or is it going to come out worse? Again, we can go through that one to one. The general consensus is the rand will weaken further coming out of this compared to the pound. Again, here's some historical numbers, so we can look at these. April 2016, the rand was at 21,399. That was particularly bad, so we can look at that as a bit of an anomaly because there's a drought, etc. So it's maybe a one-off year. Again, property investment, we should really be looking at 3 years as our minimum. Ideally, we'd be looking at 5 years. And again, 2017, another anomalies, or a couple of anomalies here, where the Brexit fears were in. All of the pound dropped. So it wasn't specifically the rand's performance, it was more the pound dropping because there was fears with Brexit, and we covered that before. There were unsubstantiated fears, at which point they pulled right back up as it looked, well, as the Conservative government looked likely, and obviously the Brexit was almost assured, and then even further now. Okay, so we've seen this significant growth. Again, if we look at this is the SEDI, so for you guys that are on in Ghana, it's even more of an aggressive line. I've not put the trend on this, but again, you can see it's even more of an aggressive line than even the rand. And with the SEDI, even at these points where there was concern previously where the pound dipped, the SEDI still performed worse. So even though the pound dipped considerably, the SEDI still was 1% or performed 1% worse in that year, where almost every other currency was doing maybe 10% better. And then, as you can see with the SEDI, you're looking at, at least on average here, you're looking at what, 10%, 12% per annum depreciation against the pound. So when we look at these two currencies, you'd most certainly be encouraging your client, and when you look at them yourselves, it makes a lot of sense to be moving your money across into the pound, because historically it's always done the same thing. So historically, it looks like if you can move the money into the pound, and then from that, does it make sense then to invest in a property? Will the property investment increase not just in value, but will the rental return do such that that money is better actually in a property in the UK than sat in a pound sterling account? Naira is slightly different. So Naira has performed well. Again, there's been changes in Lagos government, as we know. Babajide Sanwo-Olu has gone into power there, and there's been there's been some. That's obviously Lagos being one of the largest. I think it's the largest territory in Africa. But again, we can see here, the performance has been less aggressive, although we had some significant jumps. And what that shows me is there's more of a conversation with our Nigerian clients. So there's much more of a, whereby the SEDI and the rand, you'd be saying, right, okay, much more, probably more aggressively in terms of moving your money into pound. With Nigeria, there's a potential question there. Do we do it now? April 2021 is expected to see significant weakening of the Naira against the pound, predominantly because there's expectations that Nigeria will take much longer to be able to recover from the economic impacts of COVID. So ultimately, your money is weakening significantly against the pound. But then again, it looks like that will pull back round a little bit as the Naira, or as Nigeria manages to stabilize after COVID. But again, and we'll go on to the table at the end. I have a table for you guys that you can take a copy of. Just email me for. But again, what it shows us is it adds a lot more questions into the dynamic, and it'll be much more on a one-to-one. And here's the shilling. So again, shilling a bit more stable in more recent years against the pound. Again, that would be more of a conversation to be had on the shilling, whether you believe that Kenya will come out of the COVID-19 crisis, or the economic impacts of that will be better or worse than the pound. And then with that, can we make that money in pound work significantly better than just being sat in a bank account? Which obviously, if we can't, then we should probably all go home. So what I've got here is a table. This table is very, very useful for you, and it's something that it looks complex probably just looking at it now. It's not. I assure you it's very, very simple. It's just a very simple exercise that's very, very useful for you guys to do at home, but it's also useful for me to do with you over the phone. As I say, just ask me for a copy of this and we can go through it. To run through it very, very quickly, left-hand side is the dates. So we've got today, and then we've got 6 monthly intervals after that, December, June, December, June, December, June, into each year. A house price today starting at 200,000, so that's apartment or a house, whatever property price it should really say. And then each one here, we've got the currencies. So we've got the Rand, the Naira, Cedi, and the Kenyan shilling. What we can then see, and I think this is a good exercise for you to do, is for the purpose of this, because I know a few of you believe, I think incorrectly, but I know a few of you believe that the property market will drop by December 20. Now, most economic forecasts are seeing a drop now and then a lift back at the end of the year. So by the time really we've got our mortgages in place, etc., actually the property prices will go back to increasing. The market will pick back up in the UK. But I've done this for the purpose of the maybe some of you that have concerns over the property price dropping. And then I've put a bounce back much, much later on, okay? And then what I've included is the exchange rate forecasts. So you can see the Rand forecast, the Naira forecast, the Cedi forecast. And then I've put here, what is the purchase price then in your local currency? And then what is the difference? And as you can see here, even if you bought and the property price dropped by the end of the year, it didn't recover in the same way that the forecasts have shown. And actually the recovery was much, much later. Because of the depreciating value of the currency, it actually, even with a price drop, it'll actually cost you more. So even though if you looked at a property today and said, Mark, that's going to drop in value, even if it did, there's a good chance that in actual fact, for you changing your money, your best bet would still be moving your money now and just holding off for the investment, or investing and taking the rental return, because the difference in the property price compared to the rental income should cover itself, and you've got a depreciating value in terms of your own currency. And because what I've not included into these is because the mortgage rates are so significantly low at the moment, a UK investor is currently able to borrow at a rate that is lower than what the base rate used to be. So what their bank used to borrow from the central bank, they're actually getting their mortgage at that value. So they can get, UK investor can get 1.5–2% mortgage rates, which is lower than what the base rate used to be. Again, what that does is the knock-on effect of that is, as an international investor, you can borrow now at a lower rate than UK investors were borrowing at. So you can fix in a 2 or 5 year fixed mortgage at a very, very low rate and actually outperform these figures. So I've not included that in there. But what I have included is just the exchange rate and the property valuations here. And again, even moving forward into these further months here, further years, I put that as the average UK expectation. This doesn't include actually making a good investment. This is effectively talking about throwing a dart at a map and of the UK and investing there. So again, this is a good little exercise for you to go through. Effectively, almost all of the currencies, it'd work in your favor to invest now, or in the next 3–6 months, start looking at it now effectively. With the shilling, potentially not. There's a question there again with the shilling. Is it better now or later on? Is it better to lock it in now? And again, the purpose of this is so that we can sit down and have a look at this together. So you might, for instance, think, you know what, this property price I think is going to reduce further, but maybe bounce back further. And you may think that the Rand is going to perform slightly better by December of this year. And what we can do is we can move these numbers around to your own particular conclusions, or your own, maybe the worst case scenarios for you. And with those worst case scenarios, we can then come to a figure of where that'd be, and then we can come to, all right, well, when's the best date for you to look at? It might not be along with these expectations. You might think it's going to perform worse, in which case we're better, invest in next year. You might think that house prices may perform worse, but your particular currency may also perform worse, in which case, is it better to invest now? The point of this is to raise the conversation, is to look at it analytically, rather than trying to look at newspapers and the rest of it, who haven't got a clue about either the market in most cases or your own particular set of circumstances. Again, in terms of the growth rate, what it doesn't include is the 30% leverage. As you all know, you people, there's a few people on now that haven't, I don't think, invested in the UK market. When you take out a mortgage, you'll generally put down, say, 30% to 40% of the value of the property in the mortgage, and then borrow the rest. For ease of argument, if you're putting in a third of the value of the property down as your own cash, if that property grows at, say, even worst case, 3% per annum, you triple that. So you're getting 9% return on your invested amount of money, even before the rent. And the same with the rent. If you've invested a third of it and you're getting a 5% gross rent per year, you're also getting 15% on top of your, or 15% rather than the 5% on your money invested. So again, these numbers don't take that into account. As I say, that's coming to the end of the slides, and we're going to go on to the questions next. I just want to be clear that the purpose of this is not to sell to you, now is the right time to buy. I have no idea, because I don't know your specific set of circumstances. I don't know where your risk appetite is, and I don't know, other factors within that. But looking at the numbers and the exchange rates, all we can look at is that it would certainly make sense to be moving, if you agree with these numbers, to be looking at moving money into pounds or dollars. Potentially dollars, you might think it'll perform better. Maybe after the dollar crash, it might be a good time. But with pound being quite weak at the moment, it's a very, very good time in pound. Or at very, very least, what this should do for you is at least to explore the option of looking at these different markets and potentially even sitting down with me, working out, for instance, back working this, doing these numbers, work out when would be the best time for you to invest over the next 3, 6, 12 months, 10 years, whenever it happens to be, how much that would look like in terms of your own cash. So if you have maybe £100,000 or £50,000 saved in your own cash now, if that depreciates, what will that look like in a year's time? So maybe it's £40,000 in a year's time left of your £50,000. And then from that, we can look at, well, what type of property would we be looking at and what type of area? So although those properties will have sold by then, we'll at least know the exact type of property we'd want to look at as and when you're comfortable to invest. And I think that's a very good exercise, because when it is the right time, we can then invest together, but also invest very quickly, because we've spent 3 months, working out exactly the type of property we want to invest in, exactly the right time. And when those two come together at the right time with the right type of property in the right type of location, we can invest quite quickly and beat the market when these come on. So that's the end of the slides and end of the conversation. I hope that was quite useful for you. Now, myself and Reese will go through these questions that you have, and we can answer them for you now.